Today's webinar is on financial remedy tax issues, an update and refresher on those. And it's going to be presented by me, Michael Horton. I'm a barrister at Coram Chambers, specialising in financial remedy and ToLATA work. But also I'm very pleased to say I'm joined today by Sofia Thomas. Sofia is an expert accountant. She trained and qualified in personal tax at PwC. 3 years ago, she founded her own company, Sofia Thomas Limited, to offer accessible expert tax services to assist family law firms in providing clients with tax advice and support. She's one of the UK's leading experts on tax and in the context of divorce and family breakdown. And she holds a qualification with the UK's premier tax institution, the Chartered Institute of Taxation. More importantly, in the last 2 weeks, the printing presses have produced her book, Tax Implications on Family Breakdown, co-authored with James Pirrie, Family Law and Partnership, and I'm very pleased that she's going to co-present with me today. Just so a bit of housekeeping before we start. This is the last Coram lockdown webinar. Who knows if and when the second wave will come, if we'll ever do in-person seminars ever again. We may be doing some more webinars in the autumn, but this is certainly the last of our lockdown series. All of the webinars that we're doing are going to be recorded, which means that you'll be able to enjoy them at your leisure on our YouTube channel. But we also do ask that you put yourselves on mute and indeed turn off your video to save bandwidth and make sure everyone has a good experience on the webinar. The chat function is available. If you have a burning question that you want to put to either Sofia and me, please use that. We will do our best to answer them at the end of our talk. The Coram Twitter feed will be available to provide announcements of our future webinars. So you should have on your screen the PowerPoint presentation that sets out who we are and what we're doing. This slide sets out what we're going to try and cover today, and that's the changes to capital gains tax from the 6th of April this year. Some particular issues that arise in relation to that, in particular, are what is the date of disposal for the purposes of capital gains tax, whether a particular transfer will be covered by the new or the old rules. We'll also then look in depth at various different measure arrangements, the old-fashioned measure order, the transfer and chargeback, and look at the CGT and inheritance tax issues that arise in relation to those. We'll then look at the changes to what was formerly known as entrepreneurs' relief that came into force in April. And then finally, before we take your questions, we'll be looking at the very, very recent changes to stamp duty land tax announced in yesterday's mini budget. So if I can just reiterate, if you are not co-presenting with me, please, if you could, say, put yourself on mute and even turn off your video as well. And so that way we preserve bandwidth and everyone gets a nice experience. So I'm going to ask Sofia to talk us through the main changes from April this year that deal with capital gains tax. Over to you, Sofia.
Perfect, thank you. So there have been a couple of big changes for capital gains tax, which we're going to talk through, and they are now live. So I have had a couple of questions. There was a delay in the the legislation becoming live, but it is now all in place, and some of the last minute concessions that people were asking for haven't been factored in. So we are looking at reduction to the period of sorry, what am I trying to say? I'm talking about main home. So we used to have an extension of 18 months. That's now cut down to 9. And then also capital gains tax is going to be payable from within 30 days if you sell or transfer a residential property. So as we move on to the next slide, we'll just look at the mechanics of how that works. The main thing to note is that capital gains tax will be payable within 30 days from sale or transfer of a residential property, and a property disposal form needs to be submitted. So this is going to be really important when we're thinking about couples who are transferring properties outside of the tax year of separation and where there's going to be a property that's sold. You do not need to complete this new land transactions return if there's no capital gains tax payable. So that would be clients who are transferring properties within the tax year of separation. They don't need to make one of these reports. But if there's going to be capital gains tax due, it needs to be paid within 30 days, and the report also needs to be filed. This will be tricky, I think, for individuals where you're transferring a property outside the tax year of separation, so you know you're going to have tax payable. It's then where are the funds going to be sourced from within 30 days, because usually, you know, prior to this, you'd have a really extended period of time to locate those funds. So if there's going to be transfers and no immediate cash available, I would really start thinking early on in the proceedings, where is this cash going to come from, so that we can settle the appropriate liabilities. So as we move on, this is only a change to disposals on residential property. If you are not selling or transferring, or if clients are not selling or transferring residential property, the old rules still apply. So it's very feasible that you could have somebody transferring shares and a property as part of their divorce and have completely different payment dates for that individual. The CGT on the property is payable within 30 days. The CGT on the shares would be due by the 31st of January following the end of the tax year. So it can be a little bit tricky. The other thing to mention with this new CGT reporting is it's quite difficult to take advantage of any losses that you have. So if I do my CGT form today because I've sold a property last week, and then I have a loss in 4 months' time, I've got to wait until I submit my tax return at the end of the tax year in order to utilise that loss and offset it against the gain. So it's a little bit counterintuitive. So where you have multiple disposals, or an individual who potentially will be making more disposal after the divorce, they really need to be aware that if there are any losses in the pipeline, that they capture that on their end of year tax return. There's been a few other changes as well to residential property, which as we move on. And so one of them is that there's the abolition of lettings relief as we know it. So people who are familiar with the principal private residence relief will know, or may know, that in the past, if you had lived in the property as your main home, and then you'd left the property, as long as you had at one point lived there as your main home, if you rented the property out after that, you'd be able to claim additional relief. So you'd be able to claim relief even for the period of time you weren't living there. And at a maximum, this relief worked out as a tax saving of about £11,500. Now that relief's gone. So if you have clients who once lived in the main home, then rented it out for a bit and are now selling it, their relief is going to be limited in most circumstances, but we'll talk about the ones that it won't in the bit. It's going to be limited to that period of time they were living in the home, plus that additional 9 months. If you are looking lettings relief up, you might note that it does still appear on the statute books, and that's because it is available in very, very limited circumstances. And those circumstances are that the person who owns the property has to also be living in it at the same time as the tenant, which if they were doing that, you'd think they'd probably be entitled to the relief in its main form anyway. So it's very hard. So don't be taken aback if you see lettings relief is still being talked about. It's not the lettings relief that used to be available, which is the really wide scale one. And as I've mentioned, PPR relief, that last 3 months went down to 18 months. It's now 9 months. So your big flag is if you have somebody who has left the family home, if they're going to be out of the home for more than 9 months before it's sold or transferred, you need to be thinking about whether to seek some tax advice. And I think
before we move on from that, you mentioned this online property disposal form. How easy or difficult is that to deal with, bearing in mind you've got 30 days from completion to complete it?
It is, as an advisor, it's difficult because it normally takes me about 14 days to get authorised. I will say that the authorisation system is a little bit easier for the capital gains tax property disposal form. Individuals who have, if clients want to do this on their own, they might already be filing tax returns on their own. you will need to flag to them that this is a completely different system. They can still do it on their own, but they must register. So it can take a while for their number to be released to them. So just because they're already in the system is they still need to register for this separately. But once you're in it, it's quite a nice system to use, certainly from the agent perspective. And somebody who's really competent with their taxes, they possibly could handle it on their own. But just give yourself time, because we fed back as an industry that 30 days is too quick, but HMRC responded and said that it's not a surprise that you've sold or transferred your property, so you have had more than 30 days. They're just saying it's 30 days from the date of disposal, so not having enough time, they've already said, will not be a reasonable excuse.
So in effect, whether you're going to do it through an agent or do it yourself, plan ahead is the message there.
Absolutely.
So there's two sort of main changes that we're talking about. One is for the substantive rules, which are set out on the current slide, and the other that Sophia's already dealt with, which is dealing with the sort of process. Let's look at how this works in an example. You give the usual disclaimer that any resemblance to any living persons is entirely coincidental, but in this example, Boris bought a house many years ago, which obviously he lived in. About 10 years ago, he decides to move out of his house and move in with Carrie, and they live together in her house. About 2 years ago, they move into work accommodation, whether it's in Downing Street or anywhere else, that's a matter for your imagination. And so the house that Boris owns is now empty and has been for that 2-year period. And eventually, at some point in either before or after the 6th of April, the house that Boris owns is sold. And you can see we made the maths nice and simple. The ostensible capital gain here, having been bought for 200k and selling for 1.2 million, ignoring for our nice neat maths costs of purchase and costs of sale, the gain is going to be £1 million. If we look at how that works on the old rules, Boris has let out that house that he used to live in. He had it for a period of time, and therefore it was his main home. He would be entitled to PPR relief. He'll get the old, under the old rules, he'll get the lettings relief of 40,000. And if he sold before the 6th of April, he would be entitled to deemed PPR relief for the last 18 months. It's worth bearing in mind that that used to be 36 months, and it's gradually come down to 9 months. Of course, if he sold in a particular tax year, he has until the end of the January following the end of that tax year to sell. So that's the old rules, 2 potentially valuable reliefs available and a longer period of time to pay. Under the new rules, he will not be entitled to that lettings relief, the 40,000, and he'll have a deemed PPR for only the last 9 months. And bearing in mind he's been out for 2 years, there therefore will be a period of over a year which he doesn't have a principal private residence relief. And of course, he needs to pay this CGT 30 days after the sale. So you can see on the next slide the sort of before or after figures, and working it through, you can see that there's a period, the first 10 years when he lived in it, where he's entitled to relief because that's where he lived. You've then got the final period of ownership slice there, 18 months or 9 months, depending on before or after. Lettings relief obviously is in one column, and then you can see that these changes mean about £22,000 additional capital gains tax payable because the completion is on the new tax year, and the extra time to pay. And it's worth pointing out, and of course Sophia will be able to say a bit more about this, that there are other rules that apply to PPR relief. If, for instance, the parties have not lived there because of work-related reasons, then there are particular provisions that apply. So whenever you're giving an accountant a set of facts to deal with what's the CGT calculation of property, why they have lived in at some time, always give them the full facts as to when the parties lived there, if they didn't live there, why not? Were they abroad working? Were they living in accommodation provided by their employer, and so on and so forth? There may be other reliefs available. So that's the main change that came in, or the main changes that came in relation to CGT from this year. Sophia's now going to talk about the importance of the date of disposal and working out whether you are in the old or new rules.
Yeah, so I think that the date of disposal is something that, as a tax advisor, was never really that relevant, I think, when we were doing family law tax work, because usually, you know, if it was in the tax year, you had until the 31st of January to make the payment. So you just, you know, most of the time you knew whether it was in or out of the tax year. Now that we have a CGT liability within 30 days of the date of disposal, it's going to be really critical that we know what the date of disposal is. And I think that, as Mike's going to talk to us about in the next few slides, it's challenging potentially to pick what that date of disposal is going to be, and we might see HMRC giving some additional guidance actually specifically for family law matters, where I think we don't want people to be penalised because nobody's entirely sure what the date of disposal is. So at the moment, what we're relying on, or what I'm relying on, is I'm using the HMRC manual. These manuals are completely free and accessible online. So if you type that code in, it will take you to the HMRC manual, and you'll be able to read up on it yourself. But usually the ordinary date of actual transfer is the date of disposal. So if you're selling something, you'll be able to know when your date of disposal was. That's quite straightforward. When something's being transferred, different rules apply. So we really want to be thinking about this. So we've got transfers between spouses, and also deeds of trusts as well. We want to be thinking about how those are being executed and what our official date of disposal is. So this next slide is taken from the HMRC manual, and it explains where they deem the date of disposal to be. And so if you've got your assets transferred prior to decree absolute, then your date of disposal is the date of the order. If the assets are transferred after decree absolute under an order made before, then your date of disposal is the date of decree absolute. And then assets transferred after decree absolute under an order made after the decree absolute is the date of the order. So probably not that easy to follow as I'm speaking it verbally, but hopefully easy to pinpoint as you go through. And it's important for two reasons. The first is so that you know when your CGT is payable. And the second is, as we're about to talk about shortly, entrepreneurs relief, that limit of 10 million is now down to 1 million. But when we look at whether entrepreneurs relief, that 10 million or 1 million applies, we're actually looking at the date of disposal. So if you have a court order from pre the 20th of March 2020, your client may still actually be entitled to that 10 million limit for entrepreneurs relief, even though the rules have now changed, because their date of disposal is deemed to be prior to the 20th of March. And so Mike's going to run us through now some detailed examples.
Yeah, so on this slide, we can just introduce ourselves to Wendy and Harry. They have a house in their joint names. They have a property that's been rented out, and that's in Harry's name. And the shares, the other main asset in the case, are in Wendy's names. The family home needn't concern us. They're going to sell that and split it 50-50, but they're going to swap over their rental property. So Wendy will get that and Harry will get the shares. An unusual thing to do. Obviously, it's designed to provide the maximum amount of capital gains tax exposure for our examples. Just run through some different scenarios in terms of the dates of these. So in our first example, 2A, the order itself is made on the 1st of April, but the parties, in fact, effect the transfers of the rental property and of the shares in July and August this year, and for whatever reason, they do that in advance of decree absolute, which is only pronounced in 2 months' time in September. Now, effectively, they've jumped the gun. There was no obligation on them to effect those transfers, because, as we know, property transfer orders are only enforceable once decree absolute has been made. But in this scenario, the HMRC manual suggests that the date of the order is the the date of disposal. and therefore that would mean that the old rules apply, and that would therefore mean that if there's any issues about PPR relief, the old rules will apply to that, and as indeed, as Sophia said, there might be some differential treatment or more preferential treatment as far as entrepreneurs relief. Second example of this, where you have an order made on the 1st of April, decree absolute on the 3rd of April, not an unusual situation to have decree absolute following on fairly similar. Both of those are before the 6th of April, obviously, where you have transfers which follow both the order and decree absolute, and the orders made before decree absolute, it's decree absolute, which is the date of disposal. And forgive me, sorry, there you go, decree absolute is the date of disposal. Our third example, where you have an order made after decree absolute, it's the date of the order. So you can go back to that slide here, you can see that table. Some of the examples today are relatively unusual. A conventional thing these days to get your order made, then apply for decree absolute, especially if there are pension issues as well involved, and so most of the time it will be the third example about that. I'm just going to raise a few queries about these. These are the rules, they're in the manual, it's what HMRC do. You can see on this slide why it is that HMRC take this view, and because the Act deals with the Capital Gains Tax Act, the TGCA 1992, deals with the date of disposal being the date of a contract being formed. Well, it's suggested that court orders of this type don't take effect until decree absolute or the final order of dissolution of civil partnership. It is apparently well established in case law that until the order takes effect, it's contractual in nature. I'm not so sure about that. And if you want to, you can read a chapter from my book which says that they're usually not contracts. And the importance of it, the contractual analogy, is that where property is transferred pursuant to a contract, the date of the contract is the date that, sorry, the date of disposal is the date when the contract is made. Well, maybe it's not necessarily a good rationale, but they are the rules. I've put on this slide some further thoughts about it. It is certainly possible that even if you treat an order as a contract, arguably it is conditional upon there being decree absolute, because it might never take effect if there's no decree absolute. And there's a provision that says conditional contracts where you have property transferred under those, the date of disposal is when the condition is satisfied. And finally, in relation to that, where people jump the gun and transfer prior to decree absolute, it is arguable that they're not actually transferring it under the contract, and they don't have a legal obligation to do so prior to DA, but those are the rules and they're straightforward to follow. One last thing on this whole issue is it's all very clear to say to apply these various rules, but what does the date of the order actually mean? And I've asked these questions. I think the answer to the first dated ZDS agreement, that is not an order. It might be something which becomes an order if the parties try to resolve from it, but it's at that point simply just an agreement or the heads of terms. But a Rose order, even though it might be something of a legal fiction, is probably an order for this effect. And so if you had your FDR on the 1st of April and the order wasn't sealed till afterwards, it seems to me that might be a relevant consideration. It might be worth trying out that as well. So those are some of the issues that become, certainly in this period of time, important for working out when the date of disposal is. So we're going to move on to the tax issues that arise on deferred sales of the family home, and Sophia is going to talk us through tax issues and measure orders. And you're on mute.
Thank you very much. So what we're looking at here is we're going to start with one example, and then we're going to run through three different ways of clearing that example, I guess. So we've got Herbert and Wilhelmina, who jointly own a property. And on divorce, there's an agreement for the wife to remain in the home and husband to have a deferred interest once the children are grown up. So the first option that we'll look at is 3A. And what 3A says is that the property will remain in joint names and remains held as 50-50. So there's no sale until the children are 18. So in this example, there's no change and there's no disposal. So when we're thinking about whether tax is going to apply, usually we need to firstly figure out whether there's a tax point. And if there's a tax point, it's usually because the property, something has moved. So there's been a transfer of ownership or it's been sold. So in the example of 3A, none of those things happen. It doesn't mean that there's not going to be a tax implication at the end. When the property is sold, the wife will have full PPR relief, and that's because she's lived in the property for the whole period of time that she's owned it. So she doesn't need to do anything for that to apply. That will just apply automatically. The husband will have a CGT liability and a reporting obligation when the property sells. He will always have his PPR relief for the period of time that he lived in the property. He doesn't need to do anything to secure that. That is automatic. Plus, he will have the last 9 months of occupation as well, which counts towards his PPR relief. But other than that, he will have a capital gains tax liability when the property is sold. And just briefly on this point, I think when we're thinking about the main home, some things that I think are often forgotten is that you can still claim your enhancement expenditure. So even though principal private residence relief is a really valuable relief, if it's not going to cover the whole gain, then do think about whether there's been any significant capital improvements to the property, because that will help to remove some of the gain that's chargeable to tax. If we look at 3B, which is a second example, so we say here that the order provides for deferred sale, and on sale there's a 70-30 split in wife's favour. So at this point, if you recall from the beginning, husband and wife previously owned it 50-50. So what we're saying is we're going to change, and the husband is going to have 30% and the wife will have 70%. So is there a disposal from the husband? Is he transferring 20% to wife at the time of the order, or do we only need to think about the taxes on sale? So I would say that at this point there is a disposal of 20%, but whether or not you need to complete a land transactions report or pay any capital gains tax, you would have to work the numbers out. If there's no capital gains tax due, you don't need to make a land transactions report, and everybody has that £12,300 annual exemption available to them.
Yes, so we're just going to jump in here. The difference between this and the next one is that depending on how it's drafted, some laws see that this sort of eventual split of the proceeds is only affecting the transfer at the time of eventual sale, in contrast to our next example, which is where the order actually says right from the date of the order, it is held 70-30. And we know for sure in that circumstance that there will be a definite transfer of 20% at the time of the order, and that's when we need to think about the CGT. So I'll let you carry on from here if that's okay. Yes, perfect, thank you. And so we've then got our third example, which is that the order provides that property will be held 70-30 in wife's favour with the deferred sale. So at this point we've got a definite transfer of 20% at the time of the order, and so that's a tax point. So you've got two disposals from the husband. You've got 20% to wife at the time of the order, and then they're going to be disposing of their 30% to the purchaser when eventually sold. And they will have a different PPR relief computation, because first you'll have your smaller gain effectively when you do the 20% transfer, and then when you transfer the additional 30%, there'll be a longer period of time where the husband's not been in the home, so he's likely to have a higher exposure. On the initial transfer, the husband may be able to claim PPR relief even though he's not lived in the property, and he can do that by making an election under section 225B. And that is, I think it was previously extra statutory concession D6, but this is the relief that's really valuable if you're transferring to a spouse. And the next slide runs us through the conditions, if I've got that right. So he can make this election, or he can utilise this relief if all the conditions are met. So prior to moving out of the property, it was his main home. He does not elect any other property to be his main home. And between moving out and the date of transfer, it remained his wife's only main residence. If all of those conditions are met,
then he can extend his PPR relief to cover that period of time that he wasn't in the property. So that reduces his capital gains tax liability to nil. But an election must be made to HMRC within 2 years of that transfer for that relief to apply. So we've got still on example 3C. When the children grow up and H's 30% share becomes realisable, on sale, H will have a CGT liability with no PPR relief after he moved out. So that was what we were referenced earlier, which is that the period of time he lived in the home is always going to be covered. So that's never in jeopardy. But if he's moved out of the property and it's not for reasons of work, then that justifiably reasons of work, then he will have a capital gains tax liability. And the longer it takes to sell, the more that liability is potentially going up, assuming the value of the property goes up. And just to say very briefly, because I've had this question, it's not the point at which the person moves out the home that then you rebase the property. You don't do property rebasing if the person is a UK resident. You just look at the property price when it was the market value at transfer, or the sale price, and then you deduct the purchase price and any other incidentals. But if the person's living in the UK, you don't look at the value at the date they moved out and then just look at the gain for that period of time. You take a straight line apportionment method. It's different for non-residents, but that's how it works for UK residents. Okay, so if we move on, so example 3C again, if wife were able to buy out husband, section 225B relief is still potentially available, provided no other property is claimed as his PPR relief, And if H has bought another property to live in, it may be cheaper for him to elect section 225B relief and pay CGT disposal of a new property. So what we're saying here is that if a property is being transferred to the spouse at any point, even if the spouse is paying for it, you should consider whether section 225B relief applies. But if there is a circumstance where husband, in this case, let's say he's gone and purchased another property, he has to make a decision which property he wants to claim PPR relief on, because whilst he can have one property for 2001 to 2010 and another property from 2010 to 2015, he can't have two properties at the same time, apart from that final 9 months. So if he's bought another property to live in, he will need to make an election as to if he wants to claim section 225B, he's going to lose the potential PPR relief on his new property, but only for that period of time that the election covers. So it's just worthwhile thinking about whether that needs to be flagged. If somebody's purchasing a new property, they will have to make the decision whether it's going to be beneficial to claim section 225 or not. When we're talking about example 3C, this is a type of deferred interest. So it creates an interest in possession trust for the wife, and as such, it's always important to consider whether inheritance tax is going to be payable. And we're just moving on to the next slide. We've got what we need to think about with inheritance tax. So you've got a 20% tax charge on the value on entry. So that's normally inheritance tax on death is charged at 40%, but on lifetime transfers into a trust, we would charge it at 20%. And that is unless the trust is to maintain a former spouse or for maintenance of a child up to 18. You then also have your principal charges. So principal charge happens every 10 years, and it's a tax on the value of the trust. And then you have your exit charges, which is a tax every time something comes out of the trust. So trusts are really quite expensive from a tax perspective. They're very valuable for lots of reasons, but they do have tax implications that can be quite costly, especially if you're thinking about paying tax every 10 years on the value of a trust. And then again, another tax as you take any income out of the trust. So thinking of 3C, if we remember, we had the order made on the 1st of July 2020. So you've got no entry charge. Why is there no entry charge? Because it's for a child up to the age of 18. So there's no tax on entry. Then you have your periodic charge in 2030. That's because that's your first 10-year anniversary. And if we look at the values that we had in the example, H's 30% is then worth 500,000. He will have a nil rate band of 325,000, which we can then deduct. And then you have IHT payable on 175,000 at 20%. So that's £35,000. So that might be, some people might say, okay, no, that's actually worth it to achieve what we're trying to achieve. And then that's payable by the trustees. So we've got our final, I think this is our final example when we're talking about tax issues and measure orders, which is example 3D. So this order provides for a transfer of the property to wife and for wife to execute a chargeback in favour of husband for 30%. So the same as example 3C for CGT purposes. So by that we mean that there's going to be two disposals. There's going to be the first disposal of the transfer of the property, and then the second disposal when the charge is executed. So H's rights under a charge are different to a deferred interest under a trust. So a deferred charge on the property is different to having an interest in the property for trust purposes. So I've just moved on to the next slide now.
Sorry.
So that's all right. So in those cases where you've got a deferred charge, but not a deferred interest under a trust, there's no interest in possession, so there's no inheritance tax. And the other advantages of doing a deferred charge, and I hope it's like, I mean, I'm using my terminology here, is oh, actually, I think that Mike's probably going to be best to talk us through this slide, so I will hand back over.
I think what the difference between 3C and 3D is that there are many ways to have a deferred interest. The old-fashioned way is to have the deferred settlement or deferred trust for sale, where the person with the deferred interest, the husband usually, remains a beneficial owner. And that has disadvantages, obviously CGT purposes, potential IHT difficulties, but also you can see on this slide, it doesn't provide a good deal of security for the wife and the children in that property. The case called Davis and Turner, there was in fact in that case a Martin order, which is where effectively the husband says the wife could have the exclusive use of the property until his death or until her death or remarriage, and he was made bankrupt in that case. The trustee was able to secure a sale even though the wife hadn't died or hadn't remarried. And there's a particular provision in the Insolvency Act which gives the trustee in bankruptcy that right. Now, we know that for CGT purposes, doing the deferred interest by way of a transfer and chargeback is the same. HMRC view that as the same as a deferred interest. But the difference with the transfer and chargeback is that although we might think colloquially as the husband in that case having a deferred interest, in reality, he has got the benefit of a mortgage or a charge. He's simply someone who has security for the payment of a certain amount of money, which is calculated with reference to the value of the property. And that's why there's no interest in possession. And that's why this rule in Davis and Turner doesn't apply with a transfer and a chargeback. So it's again worth thinking about if you're doing deferred sales. If you can do it, and sometimes you can't, but if you can do it, it's worth doing it that way. You might not be able to do it if there's a tricky mortgagee causing a fuss or being awkward about it, but where you can, it's much better to do it that way. Our final measure example is the very rare scenario where someone takes not a proportion of the value at the time of the execution of the charge, but simply a fixed sum charge. And where that takes place, there will be a disposal of the property at the time of the transfer in the same way as before. He'll have PPR relief for the time that he lived there, plus the final 9 months, and he may again be entitled to elect section 225B relief. But the receipt of the £100,000, if he agrees to a transfer and a chargeback later on for £100,000, that is not seen as the return of capital or realisation of capital. That's simply him being repaid a debt, and so there's no CGT event on that final payment being made. So that gives you an idea of some of the CGT issues that apply on very straightforward, very commonplace orders, measure orders. It remains to be seen whether the uncertainty caused by the pandemic leads to more of these orders being made, because people are wary about selling their house now. But where that does happen, we are now fully informed of the CGT and IHT issues that arise. Moving on just quickly to unmarried couples, there's just a few tax issues that arise in relation to settling ToLATA disputes, things like that. Bear in mind that capital gains tax is a tax that arises on disposal. Stamp duty is a tax payable by a purchaser. Now, usually the spouse that buys out their other spouse's interest in the family home under a matrimonial court order is exempt from stamp duty. You don't have to worry about that. That exemption does not apply to one of the unmarried couple buying out the other share. Stamp duty is payable on that purchase. And the consideration for stamp duty purchases is the cash that changes hands, plus the share of the mortgage that the purchaser is taking on that was previously covered by the other half. And so it's not just I'm buying someone out for £100,000 or £400,000 stamp duty on £400,000. You've got to add on the share of the mortgage. And of course, the 3% surcharge would apply if that meant that well, it might apply. You have to be very careful about 3% surcharge, and when it's already at your property, depending on the nature of the property that's being bought out. In terms of other things that apply to cohabitants, they're not treated as a single unit for CGT purposes. So the rule that says in the tax year of separation, spouses can transfer at no gain, no loss to each other, that doesn't apply to cohabitants. The only other advantage for that is that cohabitants can have a PPR separate from their partners. Also bear in mind that section 225B is this provision that allows you to elect to continue your PPR when you're making a transfer to your spouse, only applies to transfers to spouses or former spouses and civil partners and former civil partners. Likewise, if you're doing a Schedule 1 case, you have to be obviously aware of the inheritance tax issues, especially if it's a fairly chunky settlement being created. There are other approaches such as a transfer and a chargeback or a license to occupy that will avoid potentially inheritance tax, although they will have their own tax issues constant with them. If, for instance, the father buys a property for mother and child to live in, and that remains in his name with a license to occupy, when that property is disposed of, there will be a CGT liability. But if it doesn't create an interest in possession trust, it won't attract IHT. So Sophia's going to talk about what was entrepreneurs relief.
Thanks. So from the 20th of March 2020, Entrepreneurs Relief changed its name and is now called Business Asset Disposal Relief. Some people are still, in some texts, it's still being referred to as Entrepreneurs Relief, which I guess is completely fine, but just be aware that you might see it being called this new name. The conditions remain predominantly the same. The big change is that the lifetime limit that was available was 10 million, and that's now going down to 1 million. So I'll just rewind a little bit and explain what Entrepreneurs Relief or Business Asset Disposal Relief is. If an individual qualifies for this relief, it means when they sell or transfer a business asset, they qualify to have their capital gains taxed at a lower rate. So for the first £1 million of disposal, they can pay a capital gains tax rate of 10%. Anything above that, they pay capital gains tax at 20%. And those are the conditions up on the board. One of the things that did change a while ago is that the individual must have owned the shares for at least 2 years. And also they must have, what's really important is that they met the conditions for the 2 years immediately prior to the sale of the assets. So if you have got a case where you have a husband and wife and they're both working in the business and it's likely that shares or business assets will be transferred, you really want to ensure both continue to work for the company or to be a director, because if one of them stops and then 2 months later you want to do a transfer, they would have ceased to meet those conditions because they have not met all the conditions in the 2 years immediately prior to disposal. So you really want to keep everything the same when somebody is transferring business assets until you've sought advice as to whether business asset disposal relief is going to apply. So on the next slide, it talks about the reduction now from 10 million to 1 million. And that's a lifetime limit. So it applies if I dispose of my business assets that are £500,000 today, then in 2 years' time I want to do it again, I can only use up my extra 500,000, and then anything above that would be taxable at 20%. So one thing, there's so much to try and fit in on this. This is really important when you're thinking about your date of disposal, because you could really have somebody who could qualify for the date of disposal prior to March, and then they still potentially have that £10 million limit on a transfer. So that's that point. Then the second point I want to make is about holdover relief. So holdover relief is also known as gift relief. It's available when business assets are being transferred. Because it's called gift relief, it kind of follows, because it's called gift relief, that it's available when there's no consideration. So it's available when one person gives business assets to another person. And what the relief says is that you can transfer the CGT to the donee. So you as the donor do not have to pay CGT on that gift, because you're not receiving anything for it. You don't have the cash to pay, but it only applies on business assets. And these used to be a really common relief that was utilised in divorce. But recently, the HMRC guidance has changed, and the guidance now says that HMRC will follow the Haynes v. Hill approach, which is that they will deem the receiving party to pay the market value of the business assets being transferred. So where there's consideration, gift relief can't apply anymore. So if you were hoping to benefit from holdover relief, or your clients to benefit from holdover relief by effectively transferring that CGT, holding the CGT over to the new spouse, that will not apply. The guidance says it doesn't apply anymore. As with all guidance, it's open to being challenged. So it's not to say that your clients definitely won't get it, but I certainly wouldn't rely on it, and really think about, if you've got business assets, you start thinking you're going to have lower, higher gains because the entrepreneur's relief limit's been reduced, and possibly less relief to benefit because holdover relief, according to the guidance, has gone. If anyone wants much more information on that, there's a few articles over it in which go into loads of detail, just pulling out all of the wording. So if you're struggling to get to sleep at night, let me know and I can send that over to you. The final thing is that start thinking about whether investors' relief is going to apply. So investors' relief is that limit hasn't been slashed. That limit still remains at 10 million. So that means that if investor relief applies, you can sell or transfer shares, and the first £10 million of the gain is taxable at 10%. Investors relief is only available though if the individual doesn't work in the company, but they are a shareholder. So this is in case of you've got a husband and wife couple, business. Let's say the wife owns the shares, but she doesn't work for the company, and she then wants to transfer. She's going to transfer her shares back to the husband on the divorce. She might benefit from investors relief. We haven't heard a lot about it recently, because you have to have owned the shares for 3 years before you qualify. So really, I think it was brought in March 2017. So it's only been from March 2020 that we'd even start seeing any of these claims. But I'd start thinking about whether that's going to be something that's going to be useful. So there is some examples, but I'm conscious of time, and I know that Mike wants to run through the new rules that have come in with stamp duty, and I think we also want to have questions. So I'm tempted to hand back to Mike to do the stamp duty, and then we've got time for questions, and people can potentially read the example in their own time.
Just one thing that I'm going to say, therefore, on the change to entrepreneurs relief is that if you've got an SJE report that says, here is the value of Mr. Smith's company, and it's got a calculation at the end done before April of the net after CGT, on the assumption that entrepreneurs relief is available. Certainly if the amount of the value is over £1 million, you'll need to redo that calculation. Of course, there are a number of other reasons why business valuation done before April 2020 might not still be valid, but there's an additional one obviously there in relation to capital gains tax. So there are some slides there that say effectively how that works in practice. Capping the relief at 1 million means that there may be some more tax payable. The final topic, therefore, is the stamp duty charges. They were announced yesterday in the sort of mini budget. It says that they were to have immediate effect. They were heavily trailed in certainly the weekend's newspapers, so I suspect most people tried to avoid completing on Monday or Tuesday this week, but if you completed last Friday, ouch. in effect, the threshold for all purchases below which there was no SDLT has gone up from 125,000 to 500,000. The current rules about first-time buyers and so on and so forth don't therefore need to apply anymore. There's no change to the additional 3% on second properties. And you can see on this slide that obviously the rates are the same once you get up to 925k, but as you know, whereas before stamp duty used to be a long time ago used to be X% of the price, it is always now X% of the amount above the limit. And so by having effectively £500,000 of purchase price that's not subject to stamp duty, it's not just the purchases under that value that benefit, it's everyone who benefits from that tranche of the purchase price being not subject to SDLT. This is supposed to be a temporary provision. It's meant to end in March next year. We'll see how that works. But in a nutshell, what it means is if you're not buying a second property, then you haven't paid any SDLT on any purchase under £500,000. And everyone, by that period, or by that price level rather, you would be paying under the old rules 15,000 of stamp duty. Anyone above 500,000 gets a 15,000 stamp duty cut. And some people have already suggested that this may not be the best use of government's money, but there it is, it's the law, and so that's that. Before we take questions, there's a quick shameless plug for Sofia's book, and you can see there the details of it, which I announced at the beginning of today's slide, published by Bloomsbury Professional, co-authored by her and James Pirrie of Family Law and Partnership. So I'm going to stop sharing my screen for the time being, and hopefully I'll be able to see what we've got by way of Menarupal at 327 says, would it be helpful a recital of the occupying spouse? I mean, I think the answer to that is that we often see provisions that both parties use their best endeavours to mitigate any CGT that arises or might arise on sale or transfer. And it's something really, I think, that people should think about before they do a deal, because especially now, where if a CGT liability arises, you've got to pay the money within 30 days. You want to know what you're going to be letting yourself in for. And so if, for instance, there were improvements done and they may need to be brought into account because it's not the family home or whatever, then it's just helpful for everybody to try and agree what they were. And obviously getting tax advice early on will mean that you should be able to identify exactly what evidence HMRC will accept by way of improvements to get your, to try and mitigate that tax liability as best as possible. So yes, have a recital that both parties will cooperate and do their best to mitigate any CGT that might arise. Start thinking early, start collecting the evidence about improvements if it's relevant. You're welcome, Mena. There's another question or a comment. Yeah, but I don't think I need to deal with that.
So,
do we
sorry. Oh, sorry. I was just going to say that if obviously this was a super quick whistle-stop tour. If anyone wants to read more, then I do have a free tax on divorce short guide for family solicitors. So I've just put the link in there, and that has lots of flowcharts and some checklists to help family law professionals think about the red flags that they need to be potentially considering. So that's also got all of what we were talking about with PPR relief in that section 225B. So if somebody wants that, then that's available as well. Just as we didn't have another question, I thought I'd mention it.
And just to say, I mean, the book is very useful about that, and certainly you can see when we were talking about the transfer of transfer and chargeback, those kinds of deferred interests. There are some worked examples that show the two disposals, the two potential CGT events, and where it might be helpful to elect to take the, as it were, the hit on the existing property that they, or the new property they buy, rather than to pay it on the deferred charge. So again, I would recommend Sofia's book in electronic format now, as well as paperback as well. So
thank you.
Okay, well, thank you very much for the question. Thank you very much for joining us. As I said, this is the last of our lockdown webinars. We may be back in the second or third wave for more webinars in the autumn, but thank you very much for joining us, and I hope you found it useful.
Thank you.